Welcome back. In this video, we'll talk about what an iron butterfly is. An iron butterfly is really the same thing as an iron condor, but it's the narrowest possible iron condor. Let's explain. In the last section on iron condors, we covered three different types. We talked about the high probability, where we're looking for a small amount of credit, but a really wide range of profitability, and a fairly substantial potential loss to that, right? So this was the high probability iron condor. We also went over the low probability condor, where we had a 1-to-1 reward to risk. We started off with a 50% potential winning rate, and we saw that we had much less room for the trade to work with. So two very different trades with different purposes. And then we finished up that section by talking about the expected move iron condor, which was more of a hybrid between the two, retaining characteristics really from both of the different iron condors, low probability and high probability. The expected move was somewhat in the middle. And in each case of iron condor, the structure was basically built by the distance between the short strikes, and then of course the width of the spread itself has some bearing on the structure of the trade. So the closer that we got these short strikes into the current price, the more narrow the trading range was. Now we're going to flip the iron condor on its ear by placing the short strikes right at the price. And this may not make any sense to you at first, but we'll go over in the next video the reasons why we would consider doing something like this. So if we create an iron butterfly at the money, right now the price is $33.97. So we would probably start off with the $33.95 strike, and we would sell an iron condor. The first thing I have to do is I have to make sure that the center strikes match at $33.95. And the next thing that we need to do is to determine the width of the butterfly, which we'll get into in subsequent videos. But for this example, let's just make this butterfly 30 points wide. And so I'm going to go out 30 points from the shared center strike of the trade, which is $33.95, and set my long calls up at $34.25. That's 30 points difference. And then I'm going to take $33.95 and subtract 30 points and put my long put down at $33.65. And you can see that I'm going to receive a large credit for this trade. And if we look at the risk profile, it's a very different looking profit and loss diagram, isn't it? So the location of the options in this trade, we have the shared center strike, where we're selling both puts and calls right at the money, in this case at $33.95. And then we have a long call up here. So I'll just say B for bought. This is a long call, and then we have a long put down here, which is also B for bought. So we're buying this option, we're selling two options right at the money, put and call, and then we're buying this long call up here. It's a condor in the fact that we have calls and puts on either side of the trade. That makes it an iron condor. But the shape of this is really a butterfly, and this is why it's called an iron butterfly. Really, it's an iron condor with the narrowest possible width. In the next video, we'll discuss why that's important.